tax credits are amounts that are subtracted from the tax that you owe. And some of those are even refundable, meaning if you overpaid in taxes, if you have money being withheld from your employer's paycheck for your taxes, if you end up overpaying, you could be refunded. In example 2, we have someone who has a tax bill of $7,550, and then a list of possible deductions that could apply for someone. In this case, they receive a child tax credit of $4,000, so a tax credit just for having one or more children, an earned income tax credit of $5,795, a child and dependent care credit of $2,600, which goes towards things like reimbursement for daycare and other things before your kids are school age, and a lifetime learning credit of $1,000, which is a credit for continuing to pursue higher education. So based off this information, we would take that tax bill and subtract out all of those different credits, meaning this person would be refunded a total of $5,845, and they would receive that money back, deposited into their account as a check, however that money comes back to them. But they overpaid based off all those credits, so they would receive a refund. In example 3, we have another situation where a person has a tax bill, but in this case has a child tax credit, earned income tax credit, actually the same tax credits, just different amounts. We would take that tax bill and subtract out those different credits. But in this case, what we would end up with is that this person will still owe an amount of $5,510. So those tax credits brought down their total tax bill, but didn't bring it all the way down to zero, definitely didn't make it negative, which would result in a refund like we saw in example 2.